When the clock strikes midnight in 2 days and we ring in the new year, the clock will also start ticking on the need for corporate America to refinance trillions of dollars in debt. That's something our senior economics reporter Steve Leisman has been digging into. He joins us right now with that story and the impact on the broader U.S. economy. This is a big deal, Steve.
Yes, it is, Becky, because debt makes downturns worse, and Wall Street's keeping a close eye in 2023 and beyond on corporate debt and the relationship with the Fed, because they have the financial crisis fresh in mind. All right, one positive factor, so-called rollover risk, the amount of debt coming due next year, not very high or not as high as it could be. Corporations, they extended maturities during low rates of the pandemic. Only about $1 trillion in investment grade and high yield need to be refinanced, or 10% of the $10 trillion market. The bigger problems you can see, that happens 24, 25, and 26, especially in 25 and 26. John Giordano, head of credit research at Cantor Fitzgerald, tells me high yield and investment grade are in decent shape, but that doesn't mean there won't be pockets of pain. We'll be paying a lot of attention on how companies manage earnings and cash flow. Well, that's because rollover risk is only one concern. Depending upon the depth of any potential downturn, earnings could come under pressure, issuers have to pay higher rates and a premium because of default concerns. There's already a hefty default premium in those rates. Yields on the lowest rated junk, they've nearly doubled from 8% to above 15% this year. Investment grade more than doubled from just below 2% to above 5% now on average. That's that red line on the bottom there. Now, many companies could find their debt crushing if they have to refinance into the current rate environment, meaning there's a foot race between the Fed lowering rates next year, if that happens, and companies refinancing. Daniel Iverson, chief investment officer at PIMCO, told me yesterday, if you're concerned about earnings, it's hard to love credit. You've got to be real cautious about most economically sensitive sectors of the market. But if Iverson doesn't love corporate credit, he doesn't hate it either. If the U.S. skirts recession, yields are attractive at these levels. Some high-quality credits, they've taken a hit that may not deserve it. High rates mean little issuance next year, so the lack of supply could keep spreads tighter and returns higher. Okay, here's the optimistic scenario. The Fed begins to cut rates before 2024 when that cliff of rollovers comes due. But the current high level of rates suggests, guys, the street is preparing for a worst-case outcome. Becky?
I mean, that's always the prudent thing to do, prepare for the worst-case scenario. Is this something that factors into the Fed's thinking at all, Steve?
I don't think right now. I think when they see that $1 trillion of rollover risk, they're like, okay, we can take that down. It does mean not a lot of issuance, which means new companies are not going to be formed. New financing for new investments aren't going to be taking place. And I think that's the kind of contraction in the economy that they're probably looking for right now, or at least contraction in new business or new activity that they're looking for. So I think they're watching it. And what they're watching, I think, most closely, Becky, is this idea of systemic risk where, and that's why I'm focused on it, and that's why I took a deep look at it. There are other areas, Becky, that I think we're going to be talking about in the next several days. There's commercial real estate credit, and there's private loans and CLOs. Those are areas where there might be a bit more risk out there than appears to be apparent in the corporate bond market.
A bit more risk suggesting that it could be systemic?
There could be, I don't know about systemic. I think those are bigger markets now that have grown a lot, Becky. And one area, especially that Iverson was telling me about, was in the loan market where credit lending standards have not been very, very tight. They've been pretty loose right there. And so that's a place where you could have bigger losses rather than the corporate bond market.